The average American adult, tested on basic personal finance questions in 2025, got less than half of them right, 49%. That is not a struggling minority. That is the national average, and it has been stuck at that exact number for 8 straight years. You spent 12 years in a classroom, yet less than a quarter of American high school students ever get access to even a single semester of personal finance education before they graduate. The current educational structure dedicates a decade to teaching the capital of Madagascar, leaving zero time to explain how a credit score is calculated, how compound interest works, or how a single bad financial decision made at 22 costs you $1 million by retirement. We are replacing this blind spot with 20 real foundational rules about money. Ignorance here has a high compounding price tag. The National Financial Educators Council found that the average adult estimates their financial blind spots cost them close to $1,000 every single year in avoidable fees, missed opportunities, and poor decisions. Rule 1, pay yourself first, always. Look at this standard flowchart. It represents the version of budgeting almost everyone learns. Income comes in, bills get paid, and whatever is left over becomes savings. That ordering feels intuitive, but it guarantees that savings competes against every other expense for priority, and it consistently loses. Paying yourself first inverts the structure entirely. The moment income arrives, a fixed percentage automatically routes straight into savings or investments before it ever touches your checking account. You treat your savings contribution with the same non-negotiable status as your rent. Take 2 people both earning $60,000, both intending to save 15%. The first treats savings as a leftover, yielding to small unplanned expenses, and actually saves closer to 7%. The second automates the exact same goal on payday. Over 10 years, that automatic sequence is the difference between $42,000 and $90,000 in contributions alone. Rule 2. Every dollar has a job. Assign it. Tracking where your money went last month is passive. Undifferentiated money sitting in a checking account gets spent on whatever feels urgent in the moment. Instead, practice zero-based budgeting. Before the month starts, you assign every single dollar of incoming cash to a specific category: rent, groceries, investments, until your unassigned total hits zero. Once you set this up, the maintenance is genuinely minimal. You are no longer asking abstract questions about whether you can afford something based on your total checking balance. You simply check if the dining out category has room left in it, making spending decisions dramatically easier. Rule 3. Your income is not your wealth. This rule catches high earners the hardest, specifically because their high salary makes the mistake look exactly like success. A household earning $250,000 a year that finances a mountain of lifestyle upgrades has less actual wealth than a household earning $70,000 a year with fully funded retirement accounts and no debt. The first household is simply a larger amount of money passing through on its way to somewhere else. Income is what flows through your hands. Wealth is what you keep. The only formula that accurately tracks your progress is your net worth. Everything you own minus everything you owe. Treating income and wealth as identical variables creates a brutal illusion. It is exactly why Goldman Sachs found that 40% of people earning over $300,000 a year report living paycheck to paycheck. Rule 4. Compound interest. The underlying math of compounding is so powerful that calling it the 8th wonder of the world is regularly attributed to Albert Einstein. Let's plot this math out. One person invests $300 a month starting at age 25, stops entirely at 35, and never adds another dime. Another person starts at 35 and invests $300 every single month for 30 straight years. Who has more money at 65? The 25-year-old wins. They invested a third as much money, $36,000 out of pocket compared to $108,000, and they end up with a larger balance, purely because of when those specific dollars started compounding. This assumes a broadly diversified index earning a historical 7% average return. Capturing that average means staying invested through market crashes and volatile years, making time the one resource you cannot buy back. Rule 5. Debt is a tool. Learn to use it or it uses you. Content that frames debt as either universally evil or completely harmless misses the mechanics. Debt is completely neutral. Watch this lever. Borrowing at a reasonable rate for an appreciating asset, like a home or reliable car, is positive leverage. But carrying a $6,000 credit card balance at 24% APR for consumption works in reverse. It violently compounds against you, generating thousands in interest. These first 5 rules form a complete cognitive operating system. They fix the sequencing, define your actual net worth, and set the fundamental forces of time and leverage. With the foundation built, we shift from mindset into pure mechanics.
Rule 6. Your network is your net worth. It is a phrase repeated so often, it has been drained of almost all practical meaning. We believe our financial habits are strictly conscious choices, driven by budgeting apps. But beneath that surface, our behavior is driven by invisible mechanics. Researchers call it social proof. You constantly calibrate what feels normal based on the immediate behavior of the people around you, largely without realizing it. Take a peer group when financing a new car every few years, upgrading apartments, and carrying credit card debt is the standard. Nobody in that group is acting recklessly by their own collective measure, because that standard of spending was set collectively. Compare that to a smaller circle that talks openly about investing, considers a paid-off car a point of pride, and treats negotiating a job offer as ordinary behavior. Those behaviors rapidly begin to feel accessible and normal to anyone in the room. 10 years later, the massive financial gap between two individuals from these different groups traces back directly to environmental exposure. It is a product of whose financial norms they absorbed by pure proximity rather than a difference in raw intelligence. You manage your wealth by taking an honest inventory of the financial defaults you have inherited from your specific environment and deliberately deciding which of those norms are actually serving you. Rule 7 addresses the legal architecture of your money. Tax evasion is the illegal concealment of income to avoid paying what you owe. It is a crime. Tax optimization is the legal utilization of structures, like retirement accounts and specific deductions, designed by the government to incentivize saving and investment. A significant number of financially literate people leave thousands of dollars on the table purely because the tax code feels intimidating. Leaving an employer match unclaimed or ignoring legal deductions surrenders wealth back to the system for no benefit to anyone. Rule 8 tackles structural fragility. The default plan for almost everyone is one job and one paycheck. If that single source disappears, the entire financial structure built on top of it collapses immediately. It is a single point of failure. A sudden job loss creates a severe cash flow crisis for a very specific reason. Your household expenses do not drop at the exact moment your income does. Look at this structural model. A person earning $80,000 carries all pressure on one pillar. A person earning $75,000 plus $5,000 from freelance work distributes that same pressure. When the primary source fails, the single pillar shatters. The two-pillar structure shifts its weight. That modest secondary stream proves you can generate income independently, completely changing your risk tolerance and negotiating leverage. True stability requires engineering income redundancy. Relying entirely on the continued goodwill of a single employer is a structural risk you can choose to design your way out of. Rule 9 exposes the deception of face value. Price is the immediate barrier to entry, the number on the tag when you walk out the door. Cost is the true economic impact of a purchase across its entire lifetime. This chart maps the reality. We start with two vehicles, an unreliable used car priced at $15,000 and a highly reliable option priced at $20,000. Over the next 5 years, the cheaper vehicle accumulates poor fuel efficiency, frequent repair bills, and steep depreciation. The final math reveals a complete reversal. The cheaper car ultimately cost $15,000 more than the reliable option. This logic applies equally to intangible choices. A high-salary job that requires constant overtime and high stress carries a hidden, compounding cost in burnout, deteriorating health, and lost time with family. Evaluating a decision based solely on its immediate sticker price guarantees poor results. You have to measure the lifetime opportunity cost. Rule 10 confronts the danger of playing it safe. Cash provides a powerful false sense of security. The balance sitting in your checking account never drops on its own, creating the illusion of perfect stability. But inflation is a relentless, invisible force. It constantly erodes the purchasing power of your money, leaving the numbers entirely untouched, while dissolving what those numbers can actually buy. Look at this ledger tracking $20,000 sitting idle.
Against a historical average inflation rate of 3%, the cash begins to hollow out. In the very first year alone, that account loses roughly $600 in real purchasing power. The statement still reads $20,000, but its actual utility in the economy has shrunk. Compound that erosion across a decade. That exact same $20,000 has now lost nearly a quarter of its true value. There was no alert, no withdrawal, and no visible theft. Holding excess cash out of a desire for safety guarantees the systematic destruction of your wealth. Rules 6 through 10 represent the underlying mechanics layer of your money. Your social surroundings, your tax architecture, your income fragility, hidden lifetime costs, and inflation are operating constantly. They exert pressure on your finances, whether you are paying attention to them or not. Explicitly naming these invisible forces is the required first step to manipulating them. You have to see the gears turning before you can adjust the machinery. Mastering these mechanics ensures your financial foundation will not collapse, but stability is only the starting line. The next 5 rules contain the active blueprint for building real, lasting wealth.
Let's start with a piece of mental math that takes 10 seconds to learn. Rule 11 is the rule of 72. It's a tool that takes an abstract percentage and turns it into a timeline you can instantly picture in years. Divide 72 by your annual rate to find the years it takes money to double. A $50,000 investment earning 9% roughly doubles to $100,000 in 8 years. Leave it alone, and by year 16, that balance doubles again to $200,000. A 9% annual return is difficult to visualize. Your money doubles every 8 years is something you can build a life around. That translation is what takes compound interest out of the textbook and makes it a tangible number useful for everyday planning. This chart shows what happens when we run that exact same shortcut in reverse. If you divide 72 by an inflation rate or an investment fee, you calculate exactly how fast your purchasing power is cut in half. Try this right now. If a fund charges you a 2% annual fee, how long does it take for that fee alone to quietly consume half your principal? 72 divided by 2 is 36. Left unchecked, that fee cuts your money in half over 36 years. You can run this calculation as a rapid gut check anytime a new fee structure crosses your path. Once you understand how cash loses value to inflation, it is tempting to invest your emergency fund to protect it. Rule 12 corrects that mistake. Your emergency fund is insurance, not an investment. Look at this market volatility. Investments, by their nature, fluctuate. If your emergency fund is tied up in the market, you face a structural risk. Job losses frequently cluster during broader economic downturns, the exact moment markets tend to be down. You could be forced to sell at a loss to cover your immediate bills. An emergency fund has exactly one job: to be fully and immediately available at its full value. Recent economic commentary suggests a benchmark of around $20,000 for many households. But look at the comparative reality. The U.S. personal savings rate recently fell to just 2.6%. The vast majority of households are far below that targeted benchmark. Leaving that cash uninvested means losing a few percentage points to inflation each year. You should view that erosion as a necessary premium. It is the cost you pay for absolute principal protection and immediate liquidity the moment a crisis hits. There is a common failure pattern among people who earn considerably more than they used to, but still feel financially stretched. Rule 13 explains it. Lifestyle inflation is the silent wealth killer. Every time income rises, there is a strong automatic pull to let spending rise proportionally right alongside it. This diverging chart tracks a clear example. The top line shows an individual receiving 4 raises over 8 years, taking their income from $55,000 to $85,000. But because they let those raises absorb into a slightly nicer lifestyle, a bigger apartment, more frequent takeout, the bottom line shows their total savings remaining completely stagnant. The fix requires a preemptive decision. Before a raise ever changes your standard of living, set up an automatic transfer to redirect 50% of that new income straight into investments. Rule 14 tackles a category of spending most people treat as a necessary evil. Rule 14. Insurance is risk transfer. It is a strict mathematical tool,
not a bet you are trying to win by extracting more in claims than you paid in premiums. To use it correctly, you evaluate the scale of the outcome. A serious illness or a lawsuit following a car accident are catastrophe tier risks. You pay a small, certain, affordable premium to transfer away a devastating cost you could not absorb on your own. But a cracked phone screen or a minor appliance malfunction, those are inconvenience tier risks. Absorbing those costs out of your savings is mathematically superior over time. These two traps, failing to lock in automatic savings from your lifestyle upgrades and carrying the burden of true catastrophic risks yourself, are the primary ways high earners accidentally sabotage years of disciplined financial progress. Rule 15 relies on decades of historical data to invalidate the instinct to jump in and out of your investments. Rule 15, time in the market beats timing the market. This chart tracks continuous market growth over multiple decades. Multiple long-term studies show that if you miss just the 10 best trading days over that entire period, your total portfolio returns are cut roughly in half compared to staying invested the entire time. The difficulty is in when those days occur. The market's absolute best recovery days cluster extremely close to its worst, most panic-inducing downturns. If you exit during a crash intending to buy back in when things settle down, you almost guarantee you will miss the specific days that generate the actual wealth. Even professional fund managers, operating with full-time teams and real-time institutional data, overwhelmingly fail to predict these clusters when compared to basic, low-cost index funds. Continuous investment works because the permanent cost of missing a clustered recovery day far outweighs the temporary pain of riding out a downturn. The market's long-term upward trend does the work, not an individual's timing skill. Rules 11 through 15 establish the mechanics. They separate people who understand financial concepts in theory from people who apply them correctly under real high-stress conditions. The final 5 rules in this series cover the behavioral realities almost nobody applies, even when they know them, and they start with the single most avoided conversation in personal finance. With your mathematical and structural mechanics now fully in place, you are ready to tackle those final rules in the next installment. Rule 16. Negotiate everything. It is the single most avoided conversation in personal finance. People avoid this conversation specifically because asking for a better rate feels uncomfortable in the moment. The data, however, shows that the discomfort lasts only a few minutes, while the financial penalty of avoiding the conversation entirely can span a lifetime. This rule applies well beyond your salary. Medical bills, service contracts, interest rates on existing loans, and large retail purchases frequently have room for negotiation built into their pricing structures. The math of this choice is highly asymmetrical. Staying silent absolutely guarantees you the sticker price sitting in front of you. Asking respectfully introduces the only statistical chance of improving it. Let's look at exactly what happens when you skip that conversation at your first job and accept a starting offer that is $4,000 lower than what you could have negotiated. Look at this graph plotting 2 career trajectories from year 0, separated by a microscopic $4,000 gap. Because future raises are calculated as a percentage of your base, that initial difference compounding every cycle, it never closes, it expands exponentially into a massive wedge. This resulting divergence isn't happening because a company is intentionally shortchanging you year after year. It happens purely through the power of compounding mathematics. A modest gap at the start of a career snowballs into hundreds of thousands of dollars in lost lifetime earnings. That simple mechanic makes the very first negotiation you ever have the highest leverage conversation of your entire working life. Rule 17. Know your effective tax rate. A widespread misunderstanding of the tax code routinely causes professionals to irrationally decline raises, bonuses, or freelance income. Look at these 3 containers representing marginal tax brackets, 10%, 12%, and 22%. They aren't flat rates applied to your entire income. They are distinct thresholds. As you earn, dollars completely fill the lowest brackets first, only spilling into the next tier once full. This means only the specific new dollars above the threshold are taxed at the higher rate. Every single dollar below that line continues being taxed exactly as it always was. Your base income remains completely untouched. Once you understand how your effective rate flows through these tiers, the math proves that a raise can never reduce your total take-home pay. It removes a fear of earning more money that was never mathematically justified to begin with. Rule 18. Diversification is your absolute protection. Concentrating assets in a single place creates a single point of failure that can undo years of careful financial progress if one thing goes wrong. This diagram illustrates the illusion of safety. Someone might think their investments are secure, but if they work for a company, hold a large amount of that same company's stock, and live in a local economy dependent on that employer, they have 3 separate lifelines tied to a single entity. Rule 19 requires a shift in how you measure all this. Track your net worth, not your income. Checking your salary is effortless, which is why people mistakenly use their paycheck as a rough proxy for their actual wealth. To find your true financial position, look at this ledger. You take the total of everything you own, your assets, and subtract everything you owe, your liabilities. That deliberate calculation is the only way to reveal your real net worth. If you check this number daily, the short-term market noise will cause emotional fatigue. But if you check it rarely, slowly creeping debt can accumulate unnoticed for years. Setting a strict quarterly cadence creates a workable operational balance. Checking 4 times a year is frequent enough to catch bad trends early and infrequent enough to ignore short-term market volatility. Rule 20 is the foundation for the entire series. Money is a tool, not a scoreboard. Operating from a scoreboard mindset, where you use wealth purely to measure yourself against your peers, drives destructive lifestyle inflation. Even when that approach technically works, the resulting success feels hollow because it answers the wrong question. Instead, evaluate every financial choice against a real, personal blueprint for the exact life you want to build. This machine represents the 20 rules we've covered in this masterclass. They do not require a finance degree or insider access. They are simply learnable mechanics that 12 years of traditional education inexplicably skipped. But attempting to execute all 20 rules simultaneously will guarantee paralysis, ensuring you follow through on none of them. Pick exactly one rule from this series that exposed a flaw in your own life. Take exactly one concrete action to fix it this week. One rule, one action. If this masterclass taught you something school never did, subscribe for more breakdowns like this one.